Well, welcome to our High Rock monthly video. I'm Scott Tomlinson, and with me on the call today is my colleague and partner and the founder of High Rock, Paul Tepsich, as well as High Rock's certified financial planning professional, Bianca Tomlinson, who's sitting in. Well, first of all, thank you to all of our clients who took the few minutes to fill out our High Rock client survey. If you have not had a chance to do so, it is still open, and I have sent the link with the email directing you to this video. So if you have some time and can, please spend a couple of minutes to fill it out. It's really helpful. So far, respondents have given us some excellent feedback. We know that our clients are almost all long-term in their thinking. The greatest number, about 57%, are focused on their wealth forecast, and another 40% focused on long-term returns. And we think that actually goes to saying a lot about our objectives and what we're trying to accomplish with our investing strategies. Well, communicating with you is also a big priority for us, and it was great to see that by and large, 97% of you say it is enough. And of our four key methods of communication, they were all deemed important, with, in fact, our quarterly report being the most valued. Well, as you know, our mandate to you is to invest our portfolios in the manner in which we would invest for ourselves, owning the exact same assets, although potentially in different proportions relative to what our respective long-term goals are. So based on that, Paula, have we seen any significant changes to the portfolios over the course of the month of October?
No, Scott, no real changes over the month of October. We've got some we suspect. Actually, we just did a trade today, but we will likely be doing some over the course of the balance of the year. Some will be taking advantage of what's called tax loss selling in certain securities that have sold off pretty dramatically. We may look at buying. There are a few that we're looking at that look kind of cheap, but we'll have some trades coming through, some positions in the balance of the year.
Tremendous, great. Well, we'll be able to update if there is any major changes. Of course, we'll update our clients in our next monthly video at the beginning of December. We own equity assets for growth and dividend income, which are largely dependent on company earnings. We own bonds or debt securities for safety and income, and we monitor the companies who issue those bonds very closely in order that we can make sure that they will continue to meet their obligations to us. Paul, do you want to comment on this at all?
Well, you've laid it out pretty well. The one observation I would have, and I picked this up maybe a couple months ago, traditionally we do investors own stocks, as you can see it in the red in the right part of the chart, in the bottom of the capital structure, for growth. And you typically own bonds, both corporate and government bonds, for an element of safety and yield. Now, most government bonds don't yield much, but some of them have had excellent total returns over the past year. And it seems to me like most investors right now, Scott, and we'll probably go through it in this depth, but most investors right now have flipped, and they're buying stocks for yield, and the yield they're trying to get is through capital gains. And some people are buying government bonds for capital gains or return, because that's what they've both done in the past year. Stocks have returned a lot, and people are using that as a yield. And bonds, some government bonds, have had excellent total returns through capital gains over the past year.
Yeah,
probably not a simple explanation, but it's certainly something we are looking at and thinking about, and feel like the world is flipped on its head right now.
Well, and that seems to me, from our perspective, to be somewhat of what we classify as a short-term strategy relative to what history has taught us about what happens over longer periods of time, I imagine.
That's for sure.
Well, as you know, and this is the segue into that, but as you know, we have been cautious, certainly on the fundamental aspects of equity investing, and have been underweight equities and overweight money market assets, very much for safety and the potential for future opportunities as they arise. As I mentioned earlier, earnings are a very important aspect of owning equities. And with 71% of companies in the S&P 500 reporting so far in the third quarter of this year, we are experiencing our third consecutive quarter of negative annual earnings growth. Now, for the fourth quarter of 2019 and the first quarter of 2020, earnings estimates are all being revised lower. So meanwhile, as we talked about, share prices continue to make new highs, record highs, and without earnings turning up, and even at the far end of this chart where earnings are in dark blue, you can see they're actually turning a little bit lower. We've got stocks going up and earnings turning a little bit lower for us. That makes it very expensive, and of course, we know that leaves them vulnerable to repricing, like what happened last December, and that's that down spike you see just above where it says value. So corporate profits and share prices have been out of sync for quite some time. CEO confidence is low, which has historically coincided with recessions. The service economy is stalling. Manufacturing is contracting. Inventories are building and sales are declining. So the ratio is rising, which again is somewhat historically recessionary in its nature.
You may want to add, Scott, those blue bars on the graph are recessionary periods.
Yeah, thank you, Paul. And consumer confidence is high, although that on the back of reasonably strong employment data, but history also tells us that recessions usually quickly follow peaks in consumer confidence, and we know that employment data is a lagging indicator. So we tend to focus a little bit more on the leading indicators to give us economic direction. And the U.S. economy is definitely slowing. The Federal Reserve, in reaction to that, has been lowering interest rates in order to try to arrest that. Whether they can or not remains to be seen, of course. And the S&P 500 continues to move in a different direction from general economic growth. Paul, any comments on that?
Well, U.S. GDP is gross domestic product in the orange line, moving down, and it's been moving down in the better part of the year. We've gone from over 3% GDP growth this time last year down to 2%, and there's expectations that we're going to be closer to 1%. Yet the white line you can see as the S&P 500 is still setting new highs. Can't reconcile that.
And then here's a chart that you sent me, but maybe you'd like to just.
Yeah, it's a little complicated, so I'll go step by step. And I'll preface it by saying this seems to work like clockwork. So the first thing are the blue shaded bars, which are obviously U.S. recessionary periods. And what we see typically, a lot of people have been talking, if any of our clients and listeners have been listening to financial news the last 3 months, there's been talk about the yield curve inverting, which means effectively that shorter term rates end up higher than longer term rates. So we've denoted that as the green line being the US 2-30-year curve. And you can see how it it flattened over the past couple years. It's been doing that for a while. The purple line, as you can see, is the S&P 500 in price, and you can see it's at its all-time peak. And the yellow line at the bottom is the federal funds rate, which is the overnight rate that the U.S. Central Bank, the Federal Reserve Board, affects through monetary policy. So you can see, if you look back historically, how this plays out every time. So you have stocks going up to record highs, you have that federal funds rate, the central bank hikes up the yellow line, the overnight rate, and then they start cutting right before a recession. So back in the early 90s, the early double O's, the 08-09 credit crisis period, and then you can see today they're doing the same thing. And we have all of the makings of that, with the yield curve actually steepens. That green line actually steepens right before a recession. Everybody's been talking about how the yield curve inverts or flattens. It actually steepens because the Fed, the Federal Reserve Board, central bank in the US, starts cutting that yellow federal funds overnight rate even more aggressively. So they've cut, Scott, I believe 3 times so far. Is that correct?
Correct, yes.
Yeah. So anyway, this is something we've been watching for a while, and now that the Fed has started to cut rates, we're feeling a bit more confident that something amiss is about to happen. The question becomes, $64,000 question, does that Federal Reserve Board, the central bank, cut that Fed funds rate and spur economic activity really quickly and avoid a recessionary period? That's the big question. We obviously don't know the answer, but we are prepared for the worst, to be honest.
And the global economy is also showing signs of stalling over the course of the last year and a bit. European Union GDP growth rate is slowing. Japan is slowing. We've seen bond yields get more negative lately. Paul, any comments on bond yields getting negative in Germany and in Japan?
Well, all through Europe. Switzerland, I think, is the most negative, but this is a really interesting dynamic, and one that we're maybe not as close to in North America yet, but Japan's had negative yields for a while, and Germany and all through Europe have got negative yields. So you think about the implications. The first one is government bond yields are typically called the risk-free rate. So when the risk-free rate becomes negative, you wonder how to value securities. That's the first observation. The second one most of our clients and listeners would ask is, why are these government bond yields negative? Why is a 10-year German Bund, a government bond in Germany or Japan, negative? Why are investors paying Germany to hold their money for 10 years? And the answer is quite simple. Because big, large pools of capital, you think about these mammoth money market funds all over the world, they need liquidity, they want safety, and a guarantee. So they're willing to pay what I would consider like a storage fee. So if you owned a bar of gold, you would have to put it in a safety deposit box at a bank. You wouldn't keep it at home, and you would pay the bank a storage fee for that safety deposit box. Investors are doing the same thing in all through Europe and Germany. And there are a whole bunch of other implications, Scott, but we won't get into them right now. But it is a dynamic that you wonder, wow, what's behind this? And there's something to read that's behind it, and I don't think it's a good one. And I fear that negative rates will come over to North America. So I think our rates are going to catch up to Europe and Japan, not vice versa.
Interesting. And, we look at the Canadian situation at the moment, very similar. Canadian GDP growth has been in decline since 2017, basically. But the Bank of Canada has been reluctant to lower interest rates, and I would say mostly because of they don't want to incite more indebtedness. Canada's households are already at almost record levels of debt. So the Bank of Canada is obviously holding back. I wonder if that has further implications for the Canadian economy if the Bank of Canada is reluctant to lower interest rates as the Federal Reserve has been doing. And if, as you say, interest rates are going to go to zero or even negative in North America, what are the implications there? So it is, again, this level of uncertainty, and it's not just it's on a global scale, really. In Canada, we look at leading indicators as well, and this morning we saw the latest business confidence data, and it was took us down to new lows. And as we can see, it tends to lead Canadian GDP growth. So we'll have to watch that very closely going forward in Canada as well. And I'm sure the Bank of Canada is going to be watching it as well. Generally speaking, on a global scale, leading indicators, according to the OECD, are at lows that we haven't seen since 2009. And so, we have to take these things into consideration. But with all of this happening, once again, the question becomes, why are stock markets like the S&P 500, why are they doing so well? Paul?
Well, this chart can sort of explain why, and it shows basically a 4-year up channel, if you want, in the shaded area with those 2 white bars in the S&P 500. And this technicals are not an exact science, that's for sure. They're more of an eyeball, but we do make investment decisions on fundamentals, technicals, and some flow that we can come across. So there is a technical picture. One could argue that that stocks are still in this up channel, if you will, and look like they're pushing higher.
Now, as we saw last year, stock prices came down to test the lower end of that channel. And I think it's fair to say that if that happens, as we did last year, we're likely going to be looking at making some purchases of equities if we get back to those better values, because the long-term trend continues to be to higher prices. But we're just looking for better values, correct?
Yeah, that on the right side of the chart, you could look around that 2600 area, obviously, would be much better value, which would be significantly lower than here, but that could happen, in a week. Who knows?
Yeah. And you want to talk about the Fed model?
Yeah, this is interesting, and we won't go into any detail on this at all, but the red line, or salmon pink as it came out, is on the left side of the curve, and that is the S&P 500. And again, you can see in the top right that it is at its all-time high. And the yellow line is the U.S. 10-year yield. So really what this shows is kind of a rotation as investors, as the government bond yield, the 10-year yield went from over 3% to down to 1.5%. And just anecdotally, socially, we all know people say, well, you can't make any money in government bonds. I mean, they're only yielding 1.5% or 2%. So what do you do with your money? Well, you plow it into the stock market. Never mind the fundamentals. You need return. And again, we go back to yield. If you can't make a yield in the bond market that suffices for your future goals, then you buy stocks and go, well, they keep going up, so that's my yield. If I can make, 10, 15%, 20%, that's a pretty good yield. But I fear, Scott, the biggest thing to read out of this model right now is massive pension funds around the globe. And if you look back historically, so pension funds are asset liability managers. They have assets in their pension fund, and they have to ensure they get a sufficient return on those assets to meet their future liabilities as employees retire employees in that company or that pension fund retire. So historically, pension funds would be heavily invested in government bonds and corporate bonds, and they got yield through true yield that came from the coupons that the bonds paid out. Now, over the last 10 years, quite frankly, since the credit crisis, when government bond yields have, as you can see in this chart, have been anywhere from 1.5 to 3, that doesn't provide enough return or yield for these massive pension funds. So they have one option, and that is really to go to the stock market and try and get the return through through more volatile securities like equities, which you showed in a chart in the very beginning. So that's one of my biggest fears, is that all these pension funds, and I know one directly who we've been talking to for a year and a half. They've given me that exact explanation. We have to be in stocks to meet our future liabilities. That, to me, is extremely scary. I don't need to say any more. If they're all long equities because they need that return for the future, boy, oh boy. Nonetheless, Scott, you can see what this has done. The lower bond yield has prompted higher stock market levels.
Right, and then that makes sense. And I second your fear, because obviously there's a significant amount of risk that these pension funds are taking on that they seem to be forced into doing.
Oh, I just read something today too. It just reminded me that a lot of U.S. state pension funds are in deep trouble. And maybe those are the ones that are more invested in bonds and not stocks. But some of these pension funds are going to end up, in a precarious position.
Yeah, something else to be concerned about. All right. Yep. And then lastly, politically, we're now about 1 year away from the U.S. election. I think we won't get into it in any significant way, but there's probably a fair bit of drama that we're going to see unfold over the course of the next year, that with the impeachment inquiry and things like that. So that certainly adds a whole nother element into the risk factors out there in markets.
Yeah, I wouldn't disagree with that. And we don't need to make any political comments, but we could all certainly recognize that, when Trump was elected in November 2016, let's say the Dow or the S&P, in fact, if we've been looking at the S&P, it was around the 2,200 level, and it's up roughly, to the almost 3,100 level right now. So it's up close to 50%. So you do have to wonder what happens if the Democrats win, and the Democratic Party seems pretty far left now, especially Elizabeth Warren, who is talking about eliminating share buybacks, which have been a big, big driver in the equity markets right now.
Okay. All right. Well, we've been a little over our time budget, but certainly we are happy and thankful that you all take the time to tune in, and we appreciate that. One note, with regard to our survey, some of our clients responded to the survey suggesting that they might like a little bit more personal contact. And if you're listening and that is the case, I certainly want to invite you to get in touch with us to tell us that you'd like more than just a semi-annual review. Send us an email. We'll set up a mutually convenient time to discuss your situation directly, but we're always available. We want to have conversations on the phone if you want to have them, and we just need you to let us know that that's the case. Anyway, thank you very much again for tuning in. Until next month, or if we see or talk to you before that. But on behalf of myself, Paul, Bianca, we want to wish you a wonderful rest of November.